Welcome to Darin Batchelder's Real Estate Investing Show. Each week, you will learn how to grow your wealth through real estate investing. Be introduced to the players that are getting it done and learn how you can get involved. And now, here's your host, Darin Batchelder.
Hello, everyone. Today we have a very special guest. We've got Mike Woodfield with us today here. Mike, appreciate you coming on the show.
Hey, thanks so much, Darin.
Absolutely. So just a little bit on how I know Mike. Last year, I decided to rent a big old bad Harley and drive down from Dallas down to Austin and meet with these guys. And so I met with Mike and his business partner, Glenn Gonzalez, and Glenn was actually on the podcast, episode 15. He also has a book called Maintenance Man to Millionaire. And I asked Mike if he can come on the show because, you know, predominantly I've had syndicators, you know, people that are focused on going out and buying assets. And Mike really focuses on the operations of the business. And so I wanted to get a different perspective and have a little bit of different discussion. So Mike has been graciously enough to come on. And with that, Mike, typically the first question I ask is how many properties and how many units you guys currently own?
Awesome. Well, I appreciate you letting me on here, Darin. This is going to be a lot of fun, and I hope that I can bring another perspective to apartment ownership. As far as what we own, we've been net sellers over the past 5 years, three or 4 years, as the market's just gone up and up and up. But we've been in acquisitions mode. We have 6 properties right now, just existing deals that are value add, totaling roughly around 1,100 units. We have another 550 units under development right now. There's at all stages of the process of development. So we're more than busy. We just closed a value add transaction, so we're still doing value add where we can find deals that have a little gas left in the tank, if you will. And we closed one in Austin about a month and a half ago. So we're very active right now.
Fantastic. So what was your background before you got involved with multifamily?
That's a great question. So I came out of college. I finished college, knowing that I was an entrepreneur. I've always been.
It's not a requirement these days, right? There's people that either leave college or don't go to college, and heck, some of them are extremely successful.
Yeah, there are.
So you got through.
I got through, probably because my mom threatened my life, back then. I had to do it. But I got through, and my wife and I had just gotten married, and we loaded up our Mazda 3 with everything we owned, and we headed from Logan, Utah to Atlanta, Georgia. And we lived there for 2 years. I worked for a investment firm out of Chicago. They basically did what we do with value-add apartments, but it was value-add business. So they would go find failing businesses that it didn't make any sense that they weren't successful other than there's just poor operations. And so we would go and apply our operational mindset and skill set and money to these companies, and we would flip them. It was like a 3 to 5 year hold and turn them. So I was on a project down there, and I oversaw about 40 employees, direct reporting to me. So it was kind of baptism by fire. And we were able to turn that company around and sell it. And at that same time, Glenn was building his portfolio up. He had transitioned from property management into syndication. And him and I were having lunch, and he says, well, I'm kind of looking for someone to mentor to bring up and partner with. And I said, well, I don't know anything about apartments, but if you'll take a risk on me and a chance on me, then I would love to work with you. And so I was his asset manager for about 4 or 5 years, and I saw a lot of things in those 4 or 5 years. Had about $300 million of multifamily go through my hands, just millions of dollars in construction and value add, and then the acquisition and disposition of 27 apartment complexes during that time. So,
great experience. And something for the listeners' perspective is look, some people think that they can't get into syndication, but you developed a relationship with Glenn, and you were upfront, like, hey, if I don't have experience, but you give me a shot. I'm a smart guy, and I could figure it out. And so he did, and you've learned the business. And
fortunately,
that's fantastic.
Yeah, fortunately, it worked out for me, and he ended up wanting to partner with me on some deals, and now we're 50-50 partners, and everything we buy, I get the upside in and the downside if there's any, and half the headache and half the reward. So we've been successful the past few years as partners and done quite well. But yeah, I mean, if someone's looking to get in the industry, it's a phone call, or it's an email away to one of us syndicators saying, hey, look, I want to try this out. I can give you an example of that. We just closed a deal on Cameron Road in Austin, Texas, and two young guys, Nico Porter and Brandon Gordon, out of San Antonio. They're hungry bulldogs, man. They're out there cold calling owners all day, trying to find deals off market, and they found one, and they brought it to us and said, well, we can't close this ourselves, and we don't have the balance sheet for it. Would you guys help us? And that's what we did. And we're in the middle of a renovation, and they're learning a ton right now. And they're young dudes, so
that's fantastic.
It takes some initiation, and it takes some guts, but you can do it.
Yeah, I would add a little bit to. I mean, you made it sound really easy by, hey, just send an email and the syndicator will and maybe it was that easy with Nico, but I think that you still have to prove yourself. Sure. You still have to build a relationship. You still have to gain the confidence of the other party that you're bringing value to the table. So like you said, these guys were hungry. These guys, and they were pounding the pavement, and they found a deal, and you guys looked at it, and you're like, you know what? It is a good deal, and so it works. Let's do it. So I think that's it can be had. It's not. I don't think it's as easy as just find one syndicator and send them an email. But if you commit to it, you can make it happen, regardless of how old you are or how much money you have.
I agree. And most guys in this space, in the syndication space, I mean, you get all kinds of personalities. I've met the best and the worst in this industry. But most of us entrepreneurs want to help other entrepreneurs out, is what I've found. And if someone approaches me and they're sincere and they want to work hard, I will absolutely give them the time of day to say, hey, look, let me help you. Because certainly people have done that for me. It's all about paying it forward in some way. And I'm sure I'll need that help down the road, someone to pay it forward,
I completely agree. And with that, I mean, it's entrepreneurs, investors, business, successful people typically want to help other people become successful. Sure. And, so I think that, but you have to take a chance. You have to tell people what you're trying to achieve. Right. You have to ask for help. Some people they're not going to come knocking at your door. No. Right? You have to go out there and build those relationships. Yeah. So let's talk operations. Sure. So operations, you buy a value add deal. Okay. Say, I don't know, what kind of vintage do you guys typically look for?
We're usually
60s, 70s, 80s, 90s.
I usually try and stay away from the 60s and early 70s. The flat roofs.
All right, so 80s, 90s.
Yeah, they'll kill you. But yeah, 80s, 90s. Usually 80s product is what we buy. Late 70s is the value add we look for. Anything above 120 to 130 units. Okay,
and you're in Austin. What other markets do you look at, or do you just
we focus on Central Texas and DFW, Fort Worth, that metroplex. We've owned in San Antonio and in Houston. Right now, we're looking a lot in the Nashville area and north of Nashville into Kentucky.
Oh, wow. So you're going out of
Yeah,
Texas.
the corridor between Nashville and Louisville is really good, and there's still some nice deals that you can get some value add on. So we own there right now a 258 unit deal. So we stick to those markets. We look at the Salt Lake City market a lot. I'm from there, so it's always nice to go back home, and I know those markets pretty well. So we're always looking for deals there as well.
Awesome. So you get a deal under contract, you close. From an operations standpoint, what's the first thing you focus on after taking over a property?
So something that you should have been doing all along is creating an asset management plan. And you call it a business plan, asset management plan, whatever you want to call it. But, you basically have to marry your underwriting to a plan that's written out in some way, right? Because what the disconnect a lot of times is between the property management and the acquisitions team. And as an asset manager or as an operations guy, or, if you've just bought one deal and you're everything, you've got to make sure that you bridge the gap between the buying of the property and what was the business plan, what was the offering memorandum, and what is going to be the plan going forward. I can't tell you how many times I've seen that disconnect happen, and what the property manager thinks should happen and what you intended to happen couldn't be further apart. And so create an asset management plan that's detailed with a plan, and you need to hand that off the day you buy it to the property manager, the regional manager, you as owners, and if you have a contractor, that guy needs to have that plan as well. Because I even go as far as having everybody sign. I have a signature block at the bottom of the plan, and everybody puts their signature on it.
Very good. So, that brings accountability to
you signed it.
In the transaction. So let's dig into that a little bit, because the business plan, project management plan, that could mean a lot of different things. So one, do you guys have your own property management company, or do you use third party?
We do both. So Glenn was in property management for years, and he owned his own management companies and sold them. As we've ramped back up in acquisitions, we've created our own and are doing the stuff in Austin, local. We're starting there. We've always known it to be tough to go out into other markets where you don't really have any economies of scale. So we use third party in areas like DFW, where we have just one property now, and down in Corpus, where we just have one property, and in Kentucky, where we just have one property. So
right. Well, that makes sense. So then you hand this property management. Talk about you mentioned disconnect.
Yes.
Talk about an example where there was a disconnect.
Oh, sure. Absolutely. So we bought a property in DFW right off of Marvin D. Love Highway. It was 356 units. And part of the plan when we started out is, look, guys, we're going to renovate half these units, leave some meat on the bone for the next guy. We're going to paint the exterior. We're going to replace the pool deck. We're going to, change the leasing office and renovate the leasing office, right? That was the plan. We're very clear what the plan was, right? Well, there was nothing to refer to after 6 months of owning it, right? And so when it got down to the pool deck, well, the contractor and the property manager decide what pool deck to put on. And it was the ugliest pool deck I've ever seen in my entire life. It was like checker.
So they didn't come back to the ownership group to get approval before.
They just went forward with it. $27,000. Right. Well, of course, I blow my top, and I call both of them and say, "What in the world are you thinking? This is the ugliest thing I've ever seen." And the contractor, fortunately enough, stepped up and said, "That was my fault. I should have consulted you. I didn't." So a near $30,000 mistake, because there was a disconnect between us and them. And it really falls on me as the owner. I should have told them, this is the stamped concrete. This is what we want. This is the design. This is the concept that we want as owners. Now you can consult that property manager and say, "Hey, what do you think? What should it look like?" But to let them decide, or to not have a plan for them to refer to of, the pool deck is going to be this color and it's stamped concrete. You may end up with a wooden pool deck, that you're.
Yeah, I mean, at the very least, hey, if you guys are picking it, you got to come to me for approval
right.
before we move forward. Yeah. So yeah, that would be a big mistake. Talk about rehab from the standpoint of, there's some listeners that are listening that have not syndicated before.
Sure.
There's some listeners that have not even passively invested before. And then there's some that are looking to scale up.
Sure.
Talk about, like, when you look at your rehab, it's obvious to a lot of syndicators, but maybe not to others. Do you want to do the external rehab first, or focus on the internal and then do the external?
That's a great question. I guess that depends on how your money can be deployed and how quickly for your CAPEX projects. My philosophy has always been doing both at the same time. You can have an exterior crew running the exterior items, and you can have an interior crew turning units. I have a motto, and I tell everybody this, but, vacancy is never the answer. You should avoid vacancy loss with everything you have, even during renovations, and if you're focused too much on the exterior, maybe some units are going vacant or interiors are taking a little too long to turn. And so you're burning money. The exterior may cost you some walk-ins or some people coming in from off the street because it looks bad. And where it also may cost you is if someone comes in and they're like, okay, you're $1,500 a month for the interior looks nice, and it's a dump outside. And so,
right.
We really like to go in and clean the exterior up right away. If there's obviously trash, you clean that up. Make sure the lawn's getting cut consistently. Get the trees trimmed and the canopies raised up. And then, immediately start the big CAPEX on the exterior so people see movement. You got to give people the vision, right? So if you're going to paint the whole exterior of the building, maybe start with that first, because that'll make a huge difference. Or if they see new roofs going on, they're like, okay, they're spending money here. They're going to fix it up. Or a new parking lot changes everything. Restriping, it makes things look nice. So I say
those are yeah, I think that's smart. I've only been in the business for like 3.5 years, and I wasn't really sure of that answer when I got going. But then the syndicate, more people I talked to, it made sense. Like what you're saying is, if you have the capital to invest painting the property and getting things going on the outside, people that drive by will see that there's movement, see that people are investing in it, and be curious. Yeah. And, you may be more apt to be able to pull a different tenant profile. Yeah. Somebody that, maybe wouldn't have stopped before because it looked run down.
That's right.
But now they're like, I like the location. It really looks like they're putting money into this. Let me take a look and see what they're doing. Yeah. And then when they go look at the interior, they're like, hey, it matches up. They're doing the interiors also. I think this is going to be a nice place to live.
Yeah. Maybe I could give, I know this podcast is all free advice, so take it for what it's worth. But, let's talk about the things that don't cost money, that aren't capital expenditures that you can do when you immediately buy the property. I mean, if you've ever talked to a property management company worth their salt, the line is clean is free, right? So, what does clean look like? And everybody has a different idea of what clean looks like. I'll give you mine. No cars that are broke down sitting in the parking lot. No cars with flat tires that have been there for 5 months. Get those towed. Get all the junkers out of the parking lot. No trash. Get trash cans out. Make sure the trash is cleaned up. This will cost you money, but you have to make sure the lawn gets cut. You have to make sure that it looks good and you have a good leasing path. Those are the big ones that you can come in and they'll change the look of a property. People will notice the difference. And the other one is trimming the trees and the bushes around the buildings. I mean, if you have these big overgrown bushes covering up half the building, it just looks bad, and, or pressure washing. If you're close to the coast and you have a lot of mold or moss that grows on these buildings, make sure your maintenance guy's pressure washing the sidewalks in the buildings. All these things, aren't huge CAPEX items, but people will notice them.
Yeah. Yeah. That's great. I mean, that's great advice for somebody that maybe, well, regardless of whether they have a big budget or a little budget, I mean, that's the first thing that should happen, right? Is these no dollar items. Mm-hmm. That's huge. So NOI, multifamily is valued off of net operating income. And, the whole goal of buying value add is you buy it and you want to increase that NOI. So you increase the valuation of the property. That can happen by increasing the revenue. It could also happen by decreasing expenses. Yeah. Kind of talk about, from an operations standpoint, some levers that you have to, either on both sides to increase income and to decrease expenses. That's
where you start, right? That's why we're in this business. So on the income side, I would say that it's not as simple, and people think it's simple, especially when they're underwriting, as, you're just going to renovate and hit your rents, and, you're going to increase the value of the property and ride off in the sunset. Oftentimes what I found,
that's the dream, right? That's the dream.
Yeah. Hey, I've heard, no, what's the word that people use? The buzzword. This is not work-life balance. What's the word that people use where it's just basically a job you can have where you don't have to be hands-on? But that's passive or, a lifestyle business. Lifestyle business is what they use. That's the word. Lifestyle business. I've heard that a lot. This business is tough, and it's not as simple as people make it sound. You've got to make sure that your business plan is happening. So if you say that I'm going to get $150 more per unit once it's renovated, you better make sure you get it. And that's not just saying, hey, manager, this one is rented for $950. I need you to rent it for $1,100. That's going in after they say they rented it for $1,100 and making sure that they did do that. So I'll start very basic is I track every lease at every property we own during the first 1.5 to 2 years of ownership. So I track renewals and I track new leases because that really is the bread and butter. The other income, yes, important. You need to make sure you're in budget. But are you doing what you said you would do? And are you getting the increases that you said you would get? Because if you are doing that, and if it is happening, then it's very simple. It's an equation, right?
Then it is a lifestyle.
Yeah, then it is. It's NOI divided by the cap rate, and you've got a value you can sell it for. You've increased the value, by millions of dollars maybe, right? So I would say the first thing to do is make sure you're tracking those rents and make sure you're hitting your underwritten rents. Make sure that's happening. Beyond that.
So let's dive into that a little bit. So what if it's not?
Well, there's a number of things that could be going on wrong. And this is the advice I gave 2 days ago to Nico and Brandon. So hopefully they're listening at home. Again, right, is I always go by the 4 Ps. The 4 Ps.
4 Ps. All right, let's do it.
People, product, price, promotion. So whenever I go and I'm assessing a property and I'm looking at what's happening here, what's going awry, or if it is going well, I still look at these things is, are the people good? Do I have the right property manager? Do I have the right sales agent? That's what I call them leasing agent. They're salespeople. Do I have the right maintenance guy whose shop is clean and the property looks good every time I'm there? Do I have the right people? Do I have the right product? When I go walk a vacant unit that they say is rent ready, is it rent ready? Or do they have bugs sitting in the tub, which I'm sure you've seen before? Or do they have a refrigerator that's sitting open? Or do they have the previous renter was a smoker and it smells like smoke in there? Is it rent ready? So is my product good? Did the maintenance guy that turned the unit make a good product that you're selling? Or is it shabby? Is it got paint drips and all that stuff? And then price. Have you done a market study lately? Maybe your market took a dip and your underwritten rents won't work anymore. And if you keep trying to put that round peg through a square hole, you're going to get eaten alive in your vacancy, because everybody's renting here and you're up here and there's your vacancy, right? You need to bring your rents down to market perhaps, or if you want to show that you're maybe a little above, I don't know, but you need to come within reason. So are you priced right? And then promotion. How is your property being marketed? There was a property years ago that we had put $4 million in CAPEX. It was 650 unit property in DFW. And we'd put nearly $4 million into renovations into this thing. And if you Googled it, what came up was the old pictures of the old property.
Oh, no. Yeah.
So
that stinks.
Yeah, it stinks. So Google's free, right? You know, and it's like, man, just take the time to go on there, get some professional photos that cost you $150, $200. Get some professional photos done, throw them up there, make sure they coincide with your website, make sure apartments.com has them, make sure it's cohesive. So you are showing the people the product rather than, some pissed off tenant that, put up a picture of a water leak. So,
right.
And are you promoting it on the right websites? If you're in a workforce housing situation, maybe apartments.com isn't the right place to post, but maybe Craigslist is, or Facebook or something like that. So, those are the 4 P's that I go by, as people.
So I like that. Let me delve into those a little bit more.
Okay.
So people.
How
do you know if you've got the right people?
That's the hardest part. I mean, there's no algorithm, it's like, there's no CoStar to go and pull a report from. It's the hardest thing to do in business. I mean, anybody that argues is crazy. That finding the right people to put on the bus is like every business owner's goal, and the way I look at the manager is she's the manager of a multi-million-dollar business. That 650 unit apartment complex we sold for almost $50 million. So she managed a $50 million business. And if she's not intelligent and if she doesn't have experience and she doesn't show up for work every day ready to tackle it, then your $50 million business is going to go down the hill. And
yeah, I mean, that on-site person, that on-site management is a critical component.
And so how do you know you have the right one? I don't have the answer to that. I can tell you, there's ways you can spot a bad one. And usually,
okay, let's talk about that.
Yeah, usually that's just unannounced site visits. If someone knows you're showing up, they'll get ready for the visit. They'll get the lawn cut. They'll make sure that trash is picked up. They'll make sure there's a few units that are made ready. So when you ask to go walk units, that they'll direct you to the ones they want you to see. But show up unannounced. It's your property. You show up whenever you want. So show up.
That's a great
walk
point.
Through the front door and say, the boss is here. Let's go walk some units. And, you looked at what you do is you look at your vacancy list and you go look at the unit that's been on the market the longest and go look at that one. That'll tell all the tales, because if there's furniture sitting in there from 4 months ago, you just know that they're not doing their job. So
right.
You can find one that's bad really easy. Finding a good one is tougher, and it just takes probably time for them to show you that they're really good.
That's great. I had an instance where I actually it was an announced visit, right? Told the regional I'm coming, and told the regional what was important to me.
Of course.
And there was a new on-site person there. And what was important to me is when a tenant walks in the door that they get up out of their chair and walk over and introduce. I don't know if everybody has that requirement, but I like that. So the person knows I'm coming, knows what time I'm coming. And I walk in and the leasing person doesn't do
Glued
it.
to their chair.
I'm like, if they don't do it when the owner, the lead GP is coming, then
they're not doing it.
They're not doing it for the tenants walking in. So that that person's no longer there. Yeah. I left that responsibility to the regional, but they made that call. But that was one example. I mean, and that was known. So if it's unannounced, they're even more lax, potentially. And if you see them pop up right away and maybe they haven't met you, they don't even know who you are, then that's a good sign, The numbers, I'm sure that's something that, look, if the numbers are really good and keep on progressing month to month, they're doing something right. If the numbers, are poor and there's struggling going on, well, that's maybe an indication that we need to spend a little bit more time seeing it. It may not be the people, but that's something that we're going to take a closer look at. It may be, or maybe not. You talked about product. You talked about bugs in the bathtub. I haven't seen that, but one of my pet peeves is the little AC vent. Everything will be clean in the place, and then all of a sudden you look up at the AC vent and it's all dusty. Like, well, clean it up.
Yep.
It's just first impressions.
First impressions. Yep. Absolutely. Yeah. I mean, if you don't have a clean leasing path, it's the path that they always walk down to show the model unit or whatever, then, people are going to see whatever. It could be a ton of leaves blew in the pool the night before and your maintenance guy didn't clean them out or whatever it is. And they're just going to be like, oh, these guys don't really care too much about their property, And so, sorry about that. And so,
no problem.
That is always on the forefront of my mind, is making sure that, those people, when they get a good first impression, whether it's online or it's when they drive by and they're looking for a place, that week they need to move in, I always make sure that I try and leave a good first impression, and that's our focus.
What about product? Like, okay, when you're looking at the deal, you're underwriting the deal, you're like, okay, I'm going to put X amount per unit into, like in your example, we're going to renovate half the units. And, here's what we're going to do. Yeah. Well, maybe, do you ever have a time where you have to pivot and either put more or less into, the rehab, internal rehab? Talk about that.
Yeah, we just did that in a property, 136 units in Dallas. We came in with a little heavier renovation budget, and the manager approached me and said, Mike, quite frankly, you don't need to do all this stuff to get these rents. We're already under rented. Why don't we just do a backsplash in the, and paint the cabinets and see what we can do? And we did that, and sure enough, she hit our rents. So we've saved, $3 or $4 grand a unit, which is just awesome, and
that's fantastic.
And that's money that, we kept. And fortunately, when COVID hit, we were able to use some of that money just to keep all the bills, paid and everything. So it really worked out just perfectly,
That's huge. Yeah. That's huge. I had another guy who he plays more in the B plus kind of A- space. And he shared like, hey, look, there's other syndicators that are out there that are putting granite and all this fancy stuff in. And what we found is that if we spend a little bit more money on some of the, external amenities, we can maybe not spend as much on the internal unit. And so finding that balance is a critical component as well.
Yeah, absolutely.
What amenities have you found kind of are the biggest bang for the buck, where the tenants just absolutely love that you spent the money on it?
Oh man, I don't like amenities, but
you don't like amenities, so you're not a big fan of that.
I'm not, but here's the thing. I'll say this: when it comes to amenities, if you have have amenities and they look bad, it can really hurt you. So, when we go in, we make sure the pool is up to date and, it's resurfaced, and we add a new pool deck and new pool furniture because, why leave that eyesore there, right? Do people use pools at apartment complexes? Not really, like hardly ever. But, you may miss one or two people that are driving through and they see a pool that this looks really bad and they're like, well, that's gross or whatever. So that's one amenity. And then, if you have a gym in the leasing office or something like that, you want to make sure that the equipment is working and that it's more.
It's not like 50 years old.
Yeah, 50 years old and like a huge like liability. So, if there's a gym and a pool, we always make sure to renovate them. Or we may kind of change the plan on the gym and change it into something else, like a after school program for kids or something like that. So, but those are the amenities. The one that's really big in Austin is a dog park. They're very inexpensive to put in, and people love them. If you live in an apartment, you're looking for a place to take your dog and get it out and have it be running around. So a dog park in an apartment is like a huge selling thing. So I would say poor amenities that look bad are never good. I think amenities that look good will at least get someone in the door and won't push them away. I don't know how much more rent you'll get for them, but right. It depends on what class of tenant you're looking for. But I think that the dog park and things like that kind of speaks to all different asset classes. Everybody loves them. So
that makes sense. I think that it's like what we were talking about before with external rehab. If you're going up in class, you're going up into the B+, A- area, then you're trying to attract a different tenant class that has a higher paying job that can afford to pay more than maybe some of the external sex and sizzle is attractive. Wow, this is nice. And gets you in the door. And but maybe for other people, they're just like very cost conscious. Sure. They're not, it's not going to be as big a win for them. So talk about RUBS. Okay. So some people know what that is. Some people don't. So one, what does it stand for? Two, what's your experience in terms of what percentage properties you find already do it? And if they don't do it, do you typically implement it?
Yeah. So RUBS, Ratio Utility Billing System, it basically just allows a property manager or owner to come back in where they're paying for utilities and to bill them back to the tenants is what that is. So yes, we do it and have done it. Usually there's a third-party company. There's some major players that take care of that stuff as far as the billing goes of the utilities. But there's certain allowable percentages that you can actually bill back to the residents in apartments. So in Texas, I think it's 90% can be billed back. And I've seen we bought properties where they were billing back like 160%, and
160.
Yeah. So they had jacked it way up, and they were paying it, but in our underwriting we had to say, look, like we've got to come back down to 90. That lowers the NOI for us, that lowers the value of the property, but we've got to keep it clean, and so. But yes, if there's a property not doing it and we're able to do it, we will. And we charge for other things like pest control. And then on some properties, we've tried doing like a trash valet type of service. And those are kind of some of the other income line items that you'll see. The RUBS definitely offsets that painful utility bill.
Yeah. So for the listeners' benefit, a while back, a lot of properties used to pay for all the utilities, and it would just be billed into the rent.
All bills paid.
And, all bills paid. And then some owners started to bill back for utilities, and then it's become more and more commonplace. Now there are still certain pockets that are very, still all bills paid type of little communities. And so it's difficult to make that, be the only, guy on the block that's doing it. But here's the big advantage to doing that is that, if you have an all bills paid property, the tenant doesn't have any incentive to, maintain electric bill and, the heating bill and the, all that. So their AC is max, their, heat is max. They have the windows open in the middle of winter, and the property's paying for it. When you start to bill back, well, now they're responsible for it. And then you're billing back a percentage, whether that's 80 or 90%. And that ends up, giving you the ability to increase the income on your property. So if you're looking at a property, this is, I don't know, you correct me if I'm wrong, but if I'm looking at a property in a market, sub-market, that most of the other properties are already doing it, and this guy's not doing it, well, that's a big opportunity for you to potentially take that property, turn that around, and increase the revenue of the property.
It really is. I mean, that's one thing that you always look at. If they're not doing that's something you would implement on all new leases going forward. And there's a lot of tricks. A lot of old apartment owners, they provided cable, and they're paying every unit. They're paying $50 a month for cable. And, a lot of people don't expect that anymore, especially if you're streaming and downloading. Like, I don't even own a DVD player, like I use my Apple TV or whatever. And a lot of people are in that same area as me. I use YouTube TV now and I stream all my TV. So, it wouldn't be really enticing for me to have my cable paid for. So we had a property where we went in and we canceled the cable contract, and it saved us, $4,500 a month. Well, that's straight to the NOI. I mean, and we didn't lose one resident. There was no pushback, and so that was major value that was added.
That's huge. That's one line
just
item. One line
Isn't
item.
that crazy?
And $4,500 a month. That's huge. Hey, when you buy a property, how do you look at? Do you buy or sell? What do you do with staff? Do you keep the staff that was already on it? Do you bring on new staff? When you sell a property, do you find another place for them, or do they go with the property? Is it on a case-by-case basis? How does that work?
I've gone through this a lot in turnover. If they're performing obviously very poorly, I look to bring in people I already know. So, in Dallas, I have 3 or 4 property managers I call today and say, hey, what are you making at your place now? What do you need to make? Let's get you over here. And I already know I can trust them. And they will come. They'll come over for more money. So if there's if I was to buy a property in Dallas today, and the manager was performing really poorly, I probably wouldn't look to give her a second shot on my dime. I'd look to bring in someone I know. And if there's not anybody I know that's available, I would trust either the third party or my own management company to make a good hire and keep them accountable. So I'm more inclined to start with people I know, but at the same time, that can bite you, right? Let's say you're down in a market like Corpus, or pick your tertiary market, and you only own one apartment complex there. You go in and you fire all the staff. Well, what if there's a labor issue in that city and you fired the only people?
There's not many people, that know what they're doing, so right? Or they're not. Maybe they're not performing to the level that you're used to, but they may be the best person. In that market.
And we've had this happen before. And I'm just speaking from experience here. Is that when you get in these tertiary markets, sometimes a $20 an hour job isn't that high paying. Right? Or they could go work at a construction site or on a plant and make $30 an hour or $28 an hour running a line, or, so you've got to know your market, and you've got to know what issues you could potentially run into if you were just to cut everybody loose well, you may have some work ahead of you, especially if the management company managing for you doesn't have any other properties there either. So that's why I say, we use third party, because I like to use whoever's an expert in that area. So if I'm happy to admit, Darin, that I'm not the expert in Oklahoma City. I don't. So if I bought a property there tomorrow, I would look to find, and I would ask some friends that I know that own there. Hey, who have you heard from that is a good property management company? And I would kind of interview people, and then I would find an expert there, rather than putting my own management company there and setting them up to fail.
Right. And that guy, he has his 3 or 4 people that he can call and say, hey, what do you need to come over here?
I just picked up a 300 unit property. I can pay you $60,000, $65,000 a year. Let's go, and so it all fits into, do we fire, do we hire new, do we keep the staff? Heck, the property's performing well, but they're just under rented. I mean, why would you fire that staff? That's just the direction of the ownership. The ownership's keeping them to where, we're cash flowing. I built these in the 80s. I'm clipping an amazing coupon here. Don't screw it up. This market can't. So it's a tired owner. Now, if you come in and you're like, all right, we're going to raise these rents up, $200 a month. They may be like, oh, that might be hard. But eventually they'll catch the vision and they'll do it, But if they're a good property manager before, they'll be a good one for you probably. So that's tough. It's different every time.
Yeah, each deal, I gotta imagine, is a different analysis. Yeah. Hey, talk about technology. So on the operations side, both in your office and out at the properties,
sure.
What kind of technology do you use that maybe bring efficiencies?
That's great. So on the syndication side, we use Syndication Pro, which basically is it's a gatekeeper for all investor data, and it's where we send out all of our deals from, email blast to. Basically, it keeps a Rolodex, an online Rolodex of our investors. So we use that, and that's been a game changer for us. We really, it's expensive, like software is, but when you get enough volume, it just makes sense to kind of bake that in the cake, and
absolutely.
So we've used that.
That does a lot. It also automates the entire document signing process,
and subscription agreements. Yep.
I mean that's a huge saver for not only you guys managing the process, but also the investors that are investing in the deal. They don't have to print off the documents and sign them and scan them back in, and so that's nice. Then I've used Syndication Pro on one deal where I was a co-sponsor, and one thing that was nice about that was it actually has that capability to have a co-sponsor, and then the investors that I have relationships with came into kind of my own little mini portal. And so that was kind of a nice feature too.
Yeah.
All right. So Syndication Pro for the syndication side, what other technology?
So we use a company called Via Software. They're out of Utah. Make a plug for them. They basically
what is that for?
They run a text messaging platform. So whenever we send out an investor update, we send it via email through Syndication Pro, and then we also send it via text through Via. So, they'll get the same update on their phone, and we get a much better click and open rate than we do through email. So we like text messaging a lot. And then if we're blasting out a deal, we send it via text as well. So it's just...
What's the difference between, say, click and open rates, email versus text?
So on email, I would say we're about a 20% open rate on offering memorandums, and on text we're more like a 65%, which I think is pretty dramatic. I mean,
that's dramatic. I mean, 3 times, and it's hard. Like it's hard to ignore a text.
It is.
I think
It's very hard to ignore a text.
It's you hear click and like you like look over.
There's no spam folder.
Email.
There's
right. Email, yeah. First of all, it could go into your spam folder, and then secondly, when you look at your email periodically, you quick scan them, right? Boom, 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 boom. But text messages, freaking for some reason, they just grab your attention.
They absolutely do. So, that's been a success. We've been successful with that. As far as operationally, I think that we're probably behind the times a little bit in that way, just because I've got so many things dialed in personally, Excel spreadsheets and tracking, methods for what I do, monthly reporting, I've got all put together, and how we like to report to our investors. So that stuff's already all built out. And then on site, we prefer to use Resman as the software. Gotcha. It's a little bit less expensive than kind of your more robust Yardi and OneSite and Entrada, but its functionality, it functions very much like an iPhone. It's just user friendly. It's maybe not as many functionalities, but as an owner and from an owner view, if I want to go pull a balance sheet or I want to get a rent roll, or it's just very simple. So
right. I've used two different systems, Resman and one other system, and Resman to me was, as an owner, was much more user friendly. Yes. Just being able to figure out where to pull the reports and that sort of thing. Hey, we've talked a lot about the value add process. Talk about new construction, new development, and the operations side related to that. How does your mind shift into, a development deal? What becomes more important to you from an operations standpoint?
Yeah, I mean, during the build process, it's the same thing. You've got to keep your contractors paid, and you got to keep them moving, which you have to do in renovations as well, or else you'll be at there's a standstill on renovations, on value add deals. So the same thing applies with new construction. You got to make sure you get the draws in and submitted on time to the bank. Don't let them sit in your inbox for, 4 or 5 days, before you submit them. Then it takes them a week to get to it, and then a week to fund it. It's like, get it in the same day. So keeping them paid is important, and that's you focus on that. And then quality control, making sure things are getting done. Talking to your architect a lot to make sure that they're building it like you wanted them to build it. So I would say, to that point, you're focused on the construction. And then, at some point you need to focus on the lease up. So you get a sign out in front and an email put together, and you need to make sure you have a website reserved, and, you're at the starting phase, right? So you do all of that, and you start taking leases and trying to sell some units. So
a couple of questions on that. One is, in the development process, what about commodities? I mean, lumber prices shot up. They've come back down like 40%. Like, how do you manage the change in commodity prices through the build?
You hope and pray is what you do. Because, during this last build, to be completely honest with you, we locked in a contract in August. We closed our loan, and we had our budget numbers put together. Contractor said, yep, we can do it for that. Let's move forward. And by the time we got to foundations and he's looking at buying wood and he's resizing it, it's gone up $700,000.
That's crazy.
Yeah. I mean, it was crazy, and it just happened, and we just had to resize the loan, and we had to personally, me and my partners had to put more money in so we didn't have to go back to the LPs and ask for more cash, because in order to get the deal done, it's move forward, and it's pony up. So
you were able to get the loan resized, though, so you and your partner didn't have to
we didn't have to come to the full,
put the entire
amount. So we went back to the bank and said, hey, here's the situation, and of course they're not happy.
Yeah.
But the good thing is banks want you to get the deal done, so they'll work with you and try their best to help you. The story we gave them lined up, and it made sense. it was, as you know, material costs had skyrocketed. Lumber had gone up 4 or 5 times. Aluminum and copper had gone up through the roof. Everything had gone up, and so
that makes sense. Let me talk about the lease-up phase now. Yeah. So I'm just going to use round numbers. So say you're going to rent it for your business plan. You're going to rent, this one particular unit for $1,200.
Okay.
Do you start up in the lease-up phase like under that number in the beginning to get some people in and get some momentum, and then start raising it each month as you start to get,
so you could do
some traction?
You could do some sort of concession up front, which is very typical in lease up. Whether it's the first 2 months for free, but it's a 14-month agreement, so it kind of burns off. Or I don't like to lower the rent over the course of the time. I would prefer that we give them an upfront concession and then charge them full freight, because that just looks better on a rent roll.
It looks better 6 months from now or a year from now when you're looking at the rent roll. They're at the full rent.
That's right.
And when you get to the point where you're going to stop concessions, you could say, "Look, we're 70% full, and everybody's at the same rate."
Yeah. So, in today's market and where we're doing these developments, I don't think we're going to give concessions on lease up, because I don't think we have to. And so that's just us benefiting from this great market right now. But we don't. The property that's being built next to us is not giving concessions, and they've leased everything up. They're doing 3 phases, but they leased 30 units up in like a month or something like that. So.
But that's another example of pivoting, right? I mean, you pivot both ways, right? So one way was, okay, all of a sudden commodity costs go up. You got to pivot. You got to go back to the bank, see if they can, upsize the loan. You got to throw in a little bit extra capital. Then on another deal, maybe in the business plan you did have concessions built in in the lease up, and then all of a sudden you're like, man, this is a hot market. We don't need to do that. So then you save that money at that point in time.
Absolutely. Yep, absolutely. And, I would say that, but we budget and we underwrite for the worst case of those two things. So we've underwritten concessions into our budget, and, our pro forma says that we'll give concessions. I'm not apt to start off on that. Like, I would prefer that we try and lease some of these units and see what our velocity is. And, if it's such that it meets what we said we would do, why not? Let's just go that path. And if we have to concess, let's, but I don't like to start out giving the kitchen sink away. Let's start the other way and see what we have to do. So.
All right, let's talk about fear.
Fear.
What part of the process are you scared, man? Everybody gets scared at some point in time.
On the new development stuff. Yeah, I mean, Glenn and I are learning quickly, and Glenn's probably known for a lot longer than me, but I'm learning quickly is that in new development, you better have some capital to go do these deals with. And, when you're putting earnest money down that's non-refundable on, 10 acres and you don't have an approved site plan yet, that's fear, because you could lose all that money and then have 10 acres that you can't build multifamily on. And so, there's some risk there initially that is very tough to swallow. And, once you go through the pre-development risk and you prove out, this will work, the city approves it, and you get the rubber stamps, that allows you to breathe a little. But there's just it takes time. It takes a lot of focus. No one's going to do that work for you. You have to do it yourself. So, I would say the fear comes in is like, are we making the right assumptions here? Is this a good deal? It's really at the beginning. And then once you're building it, it's this excitement. It's like, all right, let's get this thing done, and let's see the vision out and get people in here paying us money to live here. So,
yeah, that's awesome. Yeah, I think that gets lost with limited partners too. Yeah. Is that both on the value add side, syndicated deals, and also new development brings on a whole different aspect. But on syndicated deals, look, as the as the syndicators, you're fronting,
Yeah.
Day one, non-refundable deposits, plus all the fees associated with the attorneys and the bank loan app fee and the inspections and appraisals and all that. And,
Expensive.
and if the deal doesn't close, that's all on
You eat that.
Yeah. If the deal closes, then you're refunded those fees. But there's risk. And then on the new development side, you brought up even more. I mean, and there you could be putting money down on land and it hasn't even been zoned for multifamily.
That's right.
Now, I have talked to some syndicators that have said that, land is a little different. People have told me that it's pretty common to get the seller to agree to give you like a long period of time to get that to work.
Right. Yeah. So,
so you don't have as much money outlaid and you kind of lock up the deal. You lose a little bit, but not as much as you kind of would have.
Yeah. That's right. Yeah. Though generally there's a 6-month time period is kind of what you're given. And that's if like they don't have approved site plans and architectural drawings that are approved by the city done. If it's shovel ready and permit ready, then, you're 90-day closing, but if it's still raw land and maybe it's zone MF2 or multifamily 2, you've got a ton of work to do before you can get that thing to entitlement. And trust me, if it's not to entitlement, you're not going to get a private equity group to buy it off and to do it. You just won't. You better win the lottery or meet someone that is rich and willing to ride the risk with you because, those private equity groups look for avoiding risk in the pre-development. So.
All right. One more question on the development side. I've seen more and more syndicators starting like over the last year and a half trading up, going from C to B or B to A. Yeah. And then lately I've had more syndicators talking about, hey, things have gotten so expensive per unit on the existing properties that, maybe it just makes sense to start doing new development. Yeah. Have you guys kind of seen the same thing? And is that what's prompted you guys to start doing some more?
Well, that's why we started doing the new development. You couldn't, in Austin, you couldn't buy a C+ product or B- product for less than 180 a door or 190 a door. I mean, that would be a steal right now. You're up to 205, 210 a door. You're buying on super compressed cap rates, down in the threes. And there's just not a ton of meat on the bone. How are you supposed to cash flow when you buy at that rate unless you're able to jack the rents up $500-600 a month? And there's a lot of risk there. Can you even do that? So, naturally we were pushed that way, I think, and we have a lot of connections around where we're at and some people that wanted to partner with us on some land development deals. And so, we're able to build and be all in for less per door than some of this 80s product. And
that's crazy. So you're going to build new and your cost per unit will be less than if you were buying an existing property?
Correct.
Oh, that's huge.
Isn't that crazy? Yeah. So, but you have to go through this headache of getting something done. And I promise you, if you think value adds a headache, you have no clue, until you do a development deal, what headache means. I mean, seriously, why these development guys are all rich. It's because they pushed through and they've done it. I mean, it's so hard to do, and it takes so much effort and focus and heavy lifting that you deserve every penny you make. Right. It really is. It's a lot of work, and resizing that loan. Fortunately, we're able to go back and get an appraisal that said, "Oh, rents have gone up in the market significantly. Yes, this is palatable." But had it not been the case, we would have been dead in the water, right? Or coming up with
absolutely
$1.2 million.
Or you'd have to shell up a lot of money.
Yeah.
with the hope that you're going to get paid on the back
That's
end.
right.
So what's the next big stretch goal for you, my man?
Oh, geez. I want to lose some weight.
How many pounds?
I'm trying to lose 40 pounds.
How many pounds?
40 pounds.
40 pounds?
My wife signed me up for a half Ironman. Okay. And that's crazy to me. I'm like, this is insane. But that's the big stretch goal as far as.
So 40 pounds by when? You got to put a date on it, or else by October 30th?
Yeah, so I got some runway, but that's gonna be a challenge for me. I'm working hard on it though.
Awesome.
But as far as business goes, Glenn and I want to get these development deals in Austin that we have 3 that are active right now. We own the land on. We want to get those across the finish line, meaning all of them are under construction. One of them will be coming into pre-leasing phase in February. We want to buy another 2 value add deals by the end of the year. So those are our goals. We're going to move fast and furious to get it done.
What do you like to do outside of work?
I love my kids and my wife. We spent a lot of time together. I know that you spent time. I think you came down to Glenn's property maybe, or
I did. I brought my college-age son, and we went shooting with Glenn.
Cool.
And we went on his ranch, and he had every type of gun you could think of, and I hadn't shot guns before, so I was a hero with my son because
awesome.
he really had a great
Glenn's
time.
like a sophisticated.
Yeah, Glenn's super.
He's
nice,
like a sophisticated redneck, He's awesome, but
super nice guy.
He's the best. Yeah, I love spending time with my kids, and I really like being outdoors. I love being out on the boat or something like that. So
awesome. Well, I really appreciate you coming out and sharing the operations side. We really don't talk about this side as much.
Yeah.
I think you brought a completely different perspective, and I thank you for that. I wish you and Glenn much success going forward. Next time I'm in Austin, I will definitely look you guys up.
Please do.
And do the same if you're in Dallas.
Sure.
Listeners, I hope that you enjoyed that one. Until next week, signing off.
Thank you.
Thank you for watching Darin Batchelder's Real Estate Investing Show. If you liked the episode, please click the like button and subscribe to the show. If you already are subscribed, then thank you, and please share the show with a friend. Check out other free resources at darinbatchelder.com/learn.